Hey everyone, welcome back to Corporate Decoder. Today, we're diving into the financial world of Super League Enterprise, and it might just be a wilder ride than watching your favorite esports team get knocked out in the finals. Super League Enterprise just filed a Form 8K, which is basically a corporate something happened report. This one's all about a new debt deal. Think of it like taking out a loan, but with a twist that could either supercharge the company or leave it stuck in game over mode. Before we jump in, if you appreciate getting the lowdown on these corporate filings, make sure to subscribe. We also have a Discord community where you can chat with other finance fans, linked in the description. So, what's the big news? Super League just made a deal to get some money, a little over $145,000 from a company called 1800 Diagonal Lending. It is called a securities purchase agreement. Basically, Super League is promising something in return for the money. Let's dig into this agreement. Super League issued what's called a convertible promissory note. Basically, an IOU with a possible upgrade. They got $45,200, which is the diagonal principal. This note or IOU has a few important dates. It matures or comes due on February 15, 2026. That's when they need to pay it back unless something happens sooner. They also have to pay interest at 10% per year. Interest is like the fee you pay for borrowing money, and if they don't pay on time, the interest jumps way up to 22%. That's a pretty big penalty. Here's where it gets interesting. The company that loaned the money, Diagonal, has the option to turn their IOU into actual shares of Super League stock. This is called converting the note. The price at which Diagonal can buy the stock is tied to the market price. This means they get a discount compared to what regular investors are paying. This discount is 25%. Now, what happens if Super League messes up? The agreement lists a bunch of things that would be considered an event of default. If any of these things happen, Super League could be in serious trouble. Some of these defaults are pretty obvious, like not paying back the money or interest when it's due, but there are also others such as failing to issue shares of common stock, breaking a promise made in the deal, breaking a warranty, going bankrupt, failing to maintain the listing of its common stock on the Nasdaq capital market, meaning its stock gets kicked off the exchange, failing to comply with the reporting requirements of the Securities Exchange Act of 1934, meaning they stop filing their financial reports of the SEC, and the restatement of any financial statements. Restating financials is when a company has to correct errors in their past financial reports. If one of these events of default happens, Diagonal can demand their money back and Super League has to pay up and fast. In some cases, they might even have to pay double the amount they borrowed. There's a limit to how much of the debt can be converted into stock. Diagonal can't convert the note into so many shares that they own more than 19.99% of Super League stock. Super League didn't get the full $145,200. There was an original issue discount or ID of 4.75%. This is like a fee that comes off the top. They also had to pay Diagonal's expenses. So after everything, Super League only got $25,000. They plan to use this money for working capital and general corporate purposes, basically to keep the lights on and the business running. Now let's put this all together and talk about the big picture. This deal tells us a few things. First, Super League needed money and they needed it quickly. This kind of financing with high interest and the possibility of converting into stock isn't usually the first choice if a company has lots of options. It suggests they might have had trouble getting money from more traditional sources like banks. The fact that Diagonal gets a discount on the stock if they convert is a potential reward for taking on the risk of lending to Super League. But it also means that if Diagonal does convert, existing shareholders could see their ownership stake in the company diluted, meaning it gets smaller. The events of default are a double-edged sword. They protect Diagonal, but they also put a lot of pressure on Super League to stay on top of things. Missing a payment, even a small one, could trigger a much bigger problem. Is this good or bad for Super League? It's hard to say for sure. The money gives them some breathing room. They can invest in their business and try to grow. But the terms of the deal are pretty tough. The high interest rate and the potential for a quick payback if something goes wrong could put a strain on their finances. Overall, this deal seems risky, but also potentially necessary for Super League. The company's future may depend on how well they can manage this debt and grow their business. Alright, that's our breakdown of Super League Enterprise's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.